Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Mike Mullaney, Director of Global Markets Research at Boston Partners, to discuss April stock market performance and if sell in May and go away will hold up in 2021. Mike, it's great to see you again. Welcome back to Trade Talks.
Thanks, Jill. Nice to be here.
And April hit 10 all-time highs during the course of the month. What were those gains supported by, and which sectors stuck out?
Well, great macro backdrop, 6.4% print for a GDP, which is the second strongest print we've seen since probably the 1960s, ex the first quarter of the last quarter of last year rather. That combined with dovish statements coming back from Chairman Powell again after the FOMC meeting. So he reiterated that basically tapering is not on the table, nor are an increase in rates on the table anytime soon. Earnings have been just outstanding. Today, as through yesterday, there's been 419 of the S&P 500 companies that reported. 87% of them have beat expectations by a whopping 50%. So the numbers coming out of the street are just phenomenal right now as far as S&P 500 earnings. And we had significant progress on vaccinations and a downdraft in both new COVID cases and deaths. So it was a very strong macro backdrop, which helped propel the market higher, obviously, in April.
Mike, do you think analyst estimates were too low, or there truly was growth that was coming out of the companies, or at least on a sustainable basis?
Yeah, it's a really good question. Combination of both. Entering the year for the April period, it was expected to be up 16%. So we're blowing that number away. That was obviously kind of pre the good information about COVID and pre good information about the increase as far as the V-shaped recovery in GDP for the United States. So I think estimates were definitely underestimated coming into the year. And quite frankly, we have been, beating these estimates dramatically. Going forward, I think is the question. I think that's probably the second part of the question for you and for investors, is that we're now at levels that are being reflected in forward earnings that are pretty robust, and the market's going to have to maintain that pace in order to maintain its price level.
Thoughts around the American Jobs and Family Plans? There's a lot of money being proposed there.
Crazy amount of money. You'd have to go back to generally World War II to see the type of spending that we're seeing right now coming out of the government. This is spending that is usually only found in wartime periods. So if you look at the composition of what's being spent, obviously we had the COVID recovery portion of it, which was needed at that point in time, especially for the leisure industry. Then the Jobs Act itself, which is basically an infrastructure plan, but not overly infrastructure. And now layer on top of that, the American Family Plan, which is really a social stability plan and really very progressive, something that we haven't seen in numerous, presidential cycles.
And let's switch gears, Mike, and talk about inflation. The Fed's data says it's tempered, but my grocery and gas bills certainly do not reflect that. I mean, just look at what's happening in housing with lumber and gypsum pricing. All of this is only going to get passed to the consumer. Meanwhile, the economic recovery is hinged on consumer demand and the strength of the consumer.
Correct. And if you look at, what I follow is 10-year break-even inflation rates coming out of the Treasury market. Those are increasing at a relatively rapid pace and up about 2.5% as we speak right now, maybe a little bit higher than that. Inflation expectations over a 1-year period coming from the New York Fed, that's higher. And then if you look at prices paid within the ISM manufacturing report, that is also increasing. So you got 3 different layers of increasing inflation. Guaranteed that we're going to be, over 3% over the summer. Definitely on a headline basis and probably on a core basis, just on a base effect alone, because last summer we had deflation based upon what was happening as far as the COVID situation within the United States. So we're going to see some relatively shocking numbers for inflation. Whether they can stick or not, that's still the question. Usually inflation doesn't get real sticky until it starts filtering into wages, and that really hasn't shown up yet. So until you start seeing inflation really starting to grab hold in the wage area of things and salaries, it could be a transitory effect. We have to wait and see.
All right, and let's wrap with sell in May and go away. I have my second vaccination. I have a vacation booked. I can't wait to get out of here. But as it relates to the stock market, that adage has actually fared poorly over the last 10 years or so. What's your thoughts on that?
Correct. Yeah. So there's a lot of a lot of press on this, that it's a wise strategy to follow, and it's worked about 2/3 of the time since 1950. But the last 10 years, there's only been 2 years that it's worked, and actually you would have left a lot of money on the table if you would follow that. This year in 2021, and given that it's the first year of a presidential cycle, and that's when that old adage of sell in May, go away does not work, I wouldn't follow that this year, even though I do think the market's relatively lofty from a sentiment standpoint, and a pullback is probably not going to be surprising, but I'm not sure if it lasts for the entire summer.
Oh, Mike, it's a great lesson in trying to not time the market. Very important for long-term investors to remember. Thank you as always for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.